All right, so welcome back. So in this training, you're going to learn about annuities. Now we're going to dive deep into annuities because here's the thing: annuities is one of the most difficult parts of the life insurance exam. Most students who fail actually perform poorly on the annuities section of the life insurance exam. So this is a very long training. So we're going to divide it into multiple parts. Okay. So strap yourself in. Make sure you have a pen and paper or your notebook to take notes. Watch the entire thing from beginning to end. If you're listening on the podcast, you want to listen to the entire thing from beginning to end. So see you in the training.
Here we have a special addition here to our VIP community. We have Mr. Eddie from the great state of Georgia.
Okay, my name is Eddie. I'm based in Georgia, and I've written the exam before, but I lost about 5 points, so I don't want to try on my own again. So I'm here to get the knowledge and get it done this time.
All right. So to answer your question, the difference between immediate and deferred has to just do with the timing of benefit payments when you start to take out benefits, because we said that annuities is a retirement plan, right? The whole point of it is to give you income for life or for a specified period of time. So when do you start taking out? When do you start getting that money? Is it if it's within the first 12 months of opening that annuity policy, then it's called immediate annuity. So all it has to do with time. So if you start taking out benefit payments, if the insurance company starts to pay you out benefits, right, within 12 months, then it's called an immediate annuity. It's all talking about benefit. When do you start receiving benefit? If you receive benefit within 12 months, it's immediate. If you receive benefits, you start receiving benefits longer than 12 months after you open the annuity, it's called deferred. So 12 months and 1 day is deferred annuity, right?
Okay.
So if it's 12 months or more, then it's deferred annuity. Less than 12 months is immediate annuity. Everything has to do with your benefit payment. When
Okay.
you start receiving benefits, that's all.
Okay. So if I get you correctly, so if you're getting within 12 months, be it deferred or be it immediate, you have to specify in your application or you request for it, then it becomes either deferred or immediate.
So when you're filling out the application, they're going to ask you when would you like to start receiving benefits.
Okay.
Draw a column, on your sheet of paper. On the left side, you can put immediate annuity. On the right side, put deferred annuity, right? So with immediate annuity, number one, all immediate annuities are paid with a single premium. And I think we went over this already, Josita, so this will just be review for you, right? But all immediate annuities are paid with just a single premium. So put single premium. All immediate annuities are bought or paid for with just a single premium. Why? Because sometimes you get an immediate annuity and then 30 days later, the insurance company starts to pay you fixed income, right? So it's always bought with just a single premium. Now,
you said 30 days.
No,
is that fixed?
Example. No.
Okay, example. Okay.
Yeah, so it can be within 30 days, it can be within 60 days or
It
90
depends on
days.
the agreement. Okay.
Yeah, as long as you start receiving benefit payments within 12 months, it's
then it's immediate. Okay.
Now, deferred annuity, I say, if you start receiving benefits 12 months or more or later, then it's called deferred annuities, right? So deferred annuities, you can pay with either a single premium or you can pay with multiple premiums, or another name for multiple premiums is flexible premiums. So that means you pay 500 this month, next month you pay 300, following month you pay 1,000, right? So it can be flexible premium. Another name for it is periodic premium. So let me write it down here, because what I like to do is give you guys multiple names for the same thing, so that when you see it, because on your exam they could use either. Yeah, on your exam, I'll draw a new table here. So on your exam, they'll use different words. So you got to know, okay, so let's do your immediate and then deferred. All right. Um, so this one you only pay with single premium. Immediate, you can pay with single premium or periodic premium. Another name for that is flexible. Another name is level. All of these mean the same thing, right? So as long multiple premium, they can either be periodic. That means you're making payments whether it's every 3 months or every month or every 6 months or every year, but it's periodic, right? You make premiums every period. But again, making premiums every period, it can either be level. It can either be level.
Flexible.
Level means that the amount you pay is fixed, right? So paying 500 every single month, you're paying 400 or whatever every month. Your premium payment doesn't change, right? It's fixed. Or it can be flexible. So flexible means that it goes up, it goes down. You get to choose how much you want to pay. If this month you got a lot of money, you pay 1,000. Next month you don't have it, you pay 200, right? So your premium payments varies. But all of those are periodic premium payments, meaning you're not just paying one premium. So on your exam, when you see flexible premium, you see level, just know that it's not single, right? So, but know that immediate annuity is always paid with just single premium. Deferred can be single premium. Now, when do people usually do this, right? So for example, when people do single premium, when do people do single premium payments, right? So single premium payments. So I like to do side by side comparison so you can see it. So single premium payment. So single premium payment, you do it when you win a lottery. So lottery winning. These are examples that will be on your exam. So lottery winning, divorce settlement, inheritance, and then lawsuit or judgment, legal settlement or judgment, legal settlement. So these are the 4 examples to use on your exam, right? So anytime immediate, when it's a single premium, these are the things. So most of the time, people pay single premium when they have a boatload of money. Like I give the example all the time of one of my clients, long time ago. She was one of the lucky ones, and she married a millionaire, right? Cut long story short, the marriage didn't work out. But her divorce settlement was $6 million, right? And she was young. She was in her early 30s at the time. So she had all that 6 million. Now this is someone that I knew, and she trusted me as a financial advisor, and I even saw her life insurance policy in the past. So she reached out to me. What should I do with all this money? I got 6 million. I don't want to put in my checking account because I'll probably use it all. So what should I do? So I recommended annuities for her, right? So now, because she had that from a divorce settlement, she put that money in an annuity. She said, I don't need this money right now. I want to keep it there until I'm ready to retire. So I won't take it until, maybe I'm late 50s or early 60s. I'll start taking it. So she put it in an annuity. So sometimes people win the lottery. You have all that money. You put it in your annuity. But you only pay with single premium. Because anytime you think single premium, think about someone who has plenty of money and making one premium. Like if you are Oprah Winfrey or you're from Georgia, right? So everyone knows Tyler Perry, right? He's one of the richest men in Georgia, right? If you're Tyler Perry, you're not going to buy a house or $500,000 house. You're not going to get a mortgage on a $500,000 house. You just write a check, right? Or even a $1 million house, you're not going to get a mortgage. You just write a check, right? So because that there are rich people who don't do mortgage payment. They just write a one-time check and just pay cash for the house one time, right? So it's the same way. So when you think single premium, think about someone who has a lot of money and you just want to make one payment. And where do people usually get a lot of money from? Lottery winning, divorce settlement, inheritance, or legal settlement. Any questions? So again, so single premium, whether it's single premium, now you can have single premium deferred annuity. So like for example, the client I gave you, now the example. And guys, annuities make a lot of money. Annuities make a lot of money, but a lot of agents don't know about it, right? So for your rich clients, annuities is very good. But like for example, she was I think 33 years old at the time. She had that boatload of money, put it in the annuity. She said, I'm not touching it until I'm in my late 50s or early 60s. So, Eddie, would that be deferred or immediate annuity? You're muted.
Deferred.
Why would it be deferred?
Yeah, because as at when she put the money in, or when she needs the money, it's over 12 months.
Perfect. Josita, oh, well, I've heard the answer, so she's going to know the answer. I was supposed to ask you before. But it is more than 12 months, right? Now, so let's say, Josita, let's say you get lucky and you win the jackpot and you win, I don't know, $50 million, right?
Yeah.
You have that money. You say, you know what? I want to start receiving premium. I want to start receiving income payments. We're in October. So I want to start receiving premium payments January 1st. Receiving benefit payments January 1st. You put that 50 million in, you want to start receiving premium benefit payments January 1st. What type of annuity would that be? Immediate or deferred?
So from now to January 1st, that's less than 1 month.
If you start receiving your benefit payments, you open the account in October, right? And you start receiving benefit payments in January. What type of annuity would that be? Deferred.
Immediate annuity.
Why immediate?
Because it's less than 12 months.
Good job. You see? You understand it. So if you get a question, once you understand that, no matter how to twist and turn the questions, you're going to get it right, right? So you can have immediate premium deferred annuities. You can have immediate premium single annuities or single premium immediate annuities, right? So they do the judgment. All right, so let's get back here. I want us to do, oh, Jesus, time is flying. I want us to do some practice questions. So I know you asked about single premium versus not accumulation versus
Accumulation and annuity period.
so let me go over that with you quickly. But before I go over that, there's something I forgot to tell you, which is very important. Write this down because it's on the exam. It tricks people. Know that for both life insurance and annuities, the beneficiary cannot be the same as the insured. Because think about it, right? The insured is the person who has to die before benefit payments are paid. But if you are the insured, how will you be dead and receive money at the same time? Right? So the insured can never be the same as the beneficiary. Never, ever, ever, ever. I sound like Chris Tucker in Rush Hour. Never, never, ever, ever. So the insurer can never be the same as the beneficiary. Just know that. Whether it's for annuity, so the annuitant can never be the same as the beneficiary. And in life insurance, the beneficiary can never be the same as the insurer. Just know that. Again, we're going to ask you scenario-based questions, and we're going to go over that. But the policy owner for life insurance, the policy owner can be the same as the insured. You can get life insurance on yourself. For the same thing in annuity, the policy, the owner can be the same as the annuitant or as the insured, right? And the owner can be the same as the beneficiary. So you can get life insurance. Let's say, for example, Eddie gets life insurance on his wife. His wife is the insured. He's the owner. He's the beneficiary. If his wife dies, he gets the death benefit, right? Or let's say Josita can have insurance on her father. Her father is the insured. She's the owner. She's paying the premium. And she's the beneficiary. If her father dies, she gets the she gets the death benefit, right?
Death benefit.
Exactly. But if that happens, what type of life insurance is that called, Josita? If you get life insurance on your father, what type of life insurance is that called? But what type of ownership is it?
What type of ownership is that?
Mhm. If you get life insurance on your father is insured, and you are the owner, what type of life insurance is it? What type of ownership is it? Eddie, you want to try?
Third party.
It's third party, right?
Oh, sure. That's true.
Yeah, remember
Yeah.
third party.
Yeah,
So,
third party.
yeah, so very important. Again, Eddie, I'll share this document with you.
Okay.
I'll put it in a group chat. Also important to know that unlike life insurance, where you have to go through medical underwriting, there is no medical underwriting for annuities. Very important, because for annuities, the insurance company is not taking any risks, right? They're not taking any risks at all. So they don't care whether, because the money you put in is the money you get, maybe plus interest, but they're not risking anything. So they don't care you're sick or whatever, they don't care. But for life insurance, the company is risking money, because let's say you get $1 million policy and your premium is $100 a month. You pay $100 today, next month you die, the insurance company still has to pay your $1 million. And it's a loss for the insurance company, right? So in insurance contracts, there'll always be a winner and a loser. There'll always be someone who will get more from that contract than than the other party. One party will always get more in an insurance contract than the other party. That is called aleatory. Again, we'll come to this, but this is under unique aspects of insurance. We'll get to that. You have to know that when that happens, it's called aleatory. So they expect you, this is for Georgia, they expect you to know the 4 unique aspects of life insurance. Aleatory, you can write this down. Again, so even though we have not gotten to that topic, but I'll start to throw it out there. So when we get to it in a few days or few weeks, you say, oh, okay. I heard this last week. You remember, right? It's about repetition. And aleatory, I think it's on your exam also. Just see that. Let me just double check.
Yeah, it's there.
Yep, it's also on the exam, right? This is a core concept that will be on all 50 state exam, the unique aspects of insurance. So again, we're gonna get to that later.
Did you know?
This is like 98% of our students pass the life insurance exam. Do you know what the national pass rate is? 50%. So no matter how many times you failed your life insurance exam, no matter how old you are, no matter which part of the country you are from, we can help you pass your life insurance exam. So if you want to pass your life insurance exam without stressing, then enroll in one of our online memberships or book a free one-on-one consultation for more information. Now let's get back to our training.
But you pay that $100 and you die tomorrow, your insurance company has to pay your beneficiary $1 million. Is that equal? No. One person, you pay 100 and you get the insurance company only receive $100 in premiums, and your beneficiary receives 1 million. It's not equal, right?
Not.
So that's aleatory. Anytime you have unequal exchange of value, that's aleatory. Or that's what makes insurance contracts unique. Like for example, car insurance. You pay. I've not had accident. Last time I had accident was, I think, 2017. So for 8 years, I've not had any car accident, but I'm still paying premium every single month. By the way, my premium has gone up. I used to pay $130. Now I'm paying $160 in premium, right? I have not had any accident, but I'm still paying, right? So in that insurance contract, the insurance company is getting more because I have paid for 8 years. I've paid I've paid over $12,000, no, pretty close to $18,000 in premium in the last 8 years. And how much have I received in benefits? Zero. So the insurance company is getting more, right? So that's aleatory, right? So sometimes the insurance company will get more. Sometimes you, the insurer, you get more, but never ever will 2 parties get the same, right? So that's aleatory. So in life insurance, the reason the insurance company wants to do medical underwriting, they want to make sure they don't lose money immediately on you. You don't die, you don't get a policy, boom, next month or or 1 or 2 years later you die, right? So they'll do medical underwriting. And what are the things they look at for medical underwriting? They're looking at your age. These are the underwriting factors. You can write them down. So they're looking at your age, your health. They're looking at your gender. They're looking at your occupation. They're looking at your hobbies. And people don't also know they're looking at your criminal history, right? Or your criminal record. Yes. If you're convicted of violent crime meaning like maybe you're robbing a bank or murder or stuff like that, some insurance companies will not insure you because you're at a higher risk of dying. If you convicted of bank robbery, they know that people die while they're committing bank robbery, right? So an insurance company will be like, oh no, if we insure this guy, he robs bank. If we insure him, he may get killed doing a bank robbery. That's too high of a risk. So we're not going to insure him. So insurance companies also take into account your criminal record. A lot of people don't know that. So all these things factor in. Also, your credit history. Mhm. Your credit history. All these things go under underwriting. Again, underwriting. Again, I'm priming you guys. So what I do is before days or weeks before we cover a topic in depth, I'm going to touch on it a little bit. So I start planting the seeds. So we're going to cover underwriting. So this is on your exam outline, right? All these underwriting we're going to cover it. But again, just let you know. So these are all factors that are covered under medical underwriting or life insurance underwriting. But annuities, they don't do any of that. Any questions?
My question is
Mhm.
on this part, under the annuities, where you have beneficiary cannot be the same as annuity.
Yes.
Annuitant, sorry.
Yes. Yes.
I know the beneficiary cannot be the same as annuitant, and I know annuitant is the
The
insured.
Mhm.
I understand it for life insurance. I understand beneficiary cannot be the same, but for annuity, I was thinking that the beneficiary, which is who gets the benefit of the annuity that whatever money you're saving, can still be the annuitant.
Okay. I know this is where it gets confusing. So the best way to think about it is just think about it as this, right? The annuitant is the primary beneficiary of an annuity contract.
Mhm.
So it's the person who receives the money. So they're both the insured, and technically they're like the primary beneficiary. So they benefit from that policy first. Now, if the annuitant dies, and let's come here to now, we'll come to accumulation versus annuitization period. If the annuitant dies during the accumulation period, then all of the money, all the premiums you paid plus any earned interest goes to the beneficiary.
Okay. Okay.
So the annuitant, the beneficiary, just like life insurance, only gets money when the annuitant dies. The
Okay.
annuitant is the one who's enjoying that money. So in insurance, we have a joke. If you want to enjoy your money while you're alive, get annuity. If you want other people to enjoy your money when you die, get life
Okay.
insurance.
So basically, if I understand the concept for life insurance, you have beneficiary, then you have contingent, right?
Yes, so life
And for
insurance, you have your contingent. So you have your primary beneficiary, you have
then
your contingent or
contingent,
secondary beneficiary, then you have
yeah.
a tertiary beneficiary.
Okay, so then for annuity,
You just have
you
to.
have annuitant
Who is
before the
technically the primary
beneficiary.
beneficiary? Yes.
Okay, okay,
You have
okay.
the beneficiary, but in your mind, you know that that's the secondary beneficiary. The primary
Okay,
beneficiary is
okay,
the person who has to enjoy that money. And then
okay,
if they die during the accumulation period, whatever they paid in the total premiums and interest gets paid to the beneficiary. But if they die during the annuity period, there's no guarantee they're going to get any money. It depends the settlement option. And we'll talk about
okay. Yeah,
settlement.
it's makes sense.
We'll talk about settlement options. Settlement. Okay. Yeah. So we're going to talk about settlement options here. That's on the exam. Yeah. So we'll talk about settlement options. That's on both of you exam outline. So 5 settlement options, 6 settlement options. Okay, yeah. So these are the settlement options here. It's also called annuity benefit payment options. That's what we're talking about. So depending on the type of settlement option you select, if it's life only, that means that the annuitant will only get that benefit while they're alive. When they die, no one else gets anything. Right? So if it's life only settlement option and the annuitant dies during the annuity phase, then there is no benefit to the beneficiary. But if they selected any other option like life with guaranteed minimum, again, we'll cover this, but I'm just touching on it. If they selected life with guaranteed minimum or maybe installment fixed period, then whatever is left over goes to the beneficiary. Again, I won't go into details because we'll touch on that. So let's talk about accumulation period and annuity period quickly. In annuity, you have two periods. You have your accumulation period and your annuity period. Your accumulation period is when you're putting money in. So it's called, other names for it, it's called the pay-in period. So on your exam, they may not use accumulation period, they may use pay-in period. So it's called the pay-in period. It's called the contribution period. Another name for it is contribution period. So that's the period where you're putting money in, almost like a 401k, right? So when you're contributing money to your 401k, that's the contribution period. Now, the time where now you start to receive benefit payments is called the annuity period or the annuitization period, right? The annuity period or the annuitization period. So that's the period where now they start to pay you benefits. And other names for that is the payout period. Another name is the distribution period or distribution phase. Another name is the disbursement phase. All of those mean the same thing. Another name is called the annuity period. So it has four other names. So you got to know all those four other names. What you got to know is that the process by which, and Josita, I'm going to ask you this. What's the process by which you go from now the accumulation period to the annuitization period? What's that process called? You should know this, we'll cover it. What's that process called?
Yes. Accumulation to annuitization period.
Yeah, the period where you switch now from accumulation period to annuity period. What is that process called? This will be on your exam.
Yes. I forgot service.
Okay, no problem. All right. So remember, I used the example of like when you have a pregnant woman, right? And
Yeah.
you have to fetus in that woman's womb, right? In the woman's womb, that's called fetus, right? But the process by which that fetus now goes from being a fetus to a baby or a human being is called delivery, right? So delivery is what now transforms that fetus in the lady's womb to now being a human being or being a baby, right? Delivery, that process is called delivery. In annuity, and please write this down, the process by which you go from the accumulation period to the annuitization period or the annuity period is called annuitization. So when you go from, so when you put in money, let's say you put in money for 10 years into annuity. After 10 years now, it's okay, now it's time for you to start getting benefit payments. That process that converts the benefit payments now to annuity payout payments is called annuitization. That will convert you now from putting money into receiving money. So when that happens, then it's referred to as your annuity has been annuitized. That means you're no longer putting money in, the insurance company is getting money. So annuitization, this is the spelling of it right here. ANNUITIZATION, annuitization. Now, during the accumulation phase, know that just like your 401k, right? The money you put into your annuity grows tax deferred, not tax free. On your exam, they'll trip you up with tax free. Tax free means you never pay taxes on it. Tax deferred means you're not going to pay taxes on it now, but when you go to take it out, oh yeah, we're going to tax you. Okay, so during the accumulation period, your annuity grows tax deferred. Now, during the annuity period or during the distribution period, while they're paying you the benefits, you're going to be taxed on your profits. So what you put in will not be taxed, right? You'll be taxed on your profits. So your gain. So let's say you put in $10,000 into your annuity, you get $5,000 profit. So your annuity value is $15,000. So you'll be taxed on $5,000 profit. You'll be taxed as ordinary. That money will be taxed as ordinary income. Write this down. Very important. Ordinary income. On your exam, they're going to put capital gains. It's not capital gains. Capital gains is something else. You're going to be taxed. That money will be taxed as ordinary income.
Mm-hmm.
Now, if you take out your annuity early, before age 59 and a half, there's a 10% penalty. If you take out your money before age 59 and a half, there's a 10% penalty. Because remember, annuity is a retirement plan. So the government doesn't want you to take out all your retirement money before you retire, right? Because now if you are broke, you don't have any money in retirement, guess who has to take care of you? The government. And the government doesn't want that, right? So it's in their interest for you to keep your money there to retirement. So if you take it out early, it's called premature withdrawal. If you take it out before age 59 and a half, they say, okay, in order to discourage you from doing this, we're going to penalize you. In addition to taxing you, we're going to penalize you 10% of whatever you take out. So your penalty is 10%.
10%.
During the accumulation period, there is no guaranteed income.
Mm-hmm.
There is no guaranteed income during the accumulation because you are just putting money. You're not receiving any income. But during the annuity period, now you have guaranteed income because the insurance company will say, okay, before that, they'll ask, okay, based on your age, so let's say again, just looking, I don't want to offend anyone, right? No, but just looking at two of you, it looks like Eddie is older than you, right? Because I see gray hair, right? So, so let's say you and Eddie have an annuity, right? And two of you pay the same amount, let's say 500 every month, right? And now it's time to take out money. Because Eddie is older, let's say two of you select the same payout option. Let's say two of you select life only payout option to say, okay, pay me money for the rest of my life, and if I die, screw my beneficiary, don't give them anything, right? So you do everything the same amount, everything. But because Eddie is older, the insurance company, his monthly benefit will be higher than you because the insurance company expects Eddie to die before you, right? So they'll give him more monthly income than you, who's younger. So let's say someone who is 60 years old, the monthly payment during the annuity period will be higher than, say, someone who is, let's say, 50 years old, right? Or someone who is 70, the monthly payment will be much higher than someone who is 60 because the insurance company knows that you don't have that much time to live, so they'll give you more money. So some of the things that affect your annuity payouts will be your age. Also, your gender affects your annuity payout because we know, and Eddie, this is one of the disadvantages of being a man. We know on average that men, well, not always, but on average, men die sooner than women, right?
Yeah.
Most of us, both grandparents, I lost from both sides of my family. I lost my grandfathers before my grandmothers, right? Now, there are a lot of reasons. I'm not going to get into trouble for that. But we know that men, on average, die sooner than women, right? So the insurance company, you'll notice that for men, all things being equal, your payout will be a little higher than a woman because they expect you to die sooner than a woman. Any questions?
Yeah.
Okay. I know I've covered a lot of things, but I'll share all these notes with you. So now let's do a few practice questions here, because all right. So I've already highlighted the correct answers here for you, Eddie. But I'm going to send you these questions also, because you can see here. I mean, I don't know. There's no way to hide.
There's a way you said, just go to return.
Huh?
Return
Where return?
on your left. I don't know if you're right or yes, there.
Oh, okay. No, you know what? It's very easy. I'm just going to deselect the answers.
Okay.
Yeah, that's what you're supposed to do.
Yeah. So
No, you use it. Okay.
yeah, you should close your eyes now. Yeah, you don't want to. You don't want to test. Okay. So I'll just do everything blank. And close your eyes, because I want to. Okay, all right. You can open your eyes now. So, what's question number one? What's the answer? And you can read it out, Eddie, for those listening on the podcast, so you can read it out and give your answer.
Okay, which best describes the difference between the accumulation period and the annuity period? A, accumulation period is when premium and increase.
No, interest.
Sorry?
When premiums earn interest.
Oh, where premium and interest. Okay, yeah. Annuity period is when benefits are paid. B, accumulation period is always shorter than the annuity period. C, accumulation period guarantees income. Annuity period has no guarantees. D, annuity period applies only to variable annuities.
Okay, so what's the correct answer? I know Josita knows this one, but for you, what's the answer?
I'll say A.
A?
Annuity period is when premiums are earned. No, annuity period is always shorter. Annuity period accumulates guarantees income. Annuity period is when benefits are paid. Yeah, A.
What about you for Josita?
Yes, A.
Okay, yep. And let's see if you're correct. So correct answer here is A, accumulation period. The main difference, again, this is asking for the difference between accumulation period and annuity period, right? So we say accumulation period is where you earn interest, and during the annuity period is when benefits are paid. Josita, give me 4 other names for annuity period.
When we talk about annuity period, you have a distribution period. We have it's a payout period. It's a disbursement period.
One more.
And yeah, I think it's 3 enough.
No, 4.
One more. Distribution, payout, disbursement period.
And one more.
Annuitization period.
What?
No. Yeah, I don't know.
Say what you said.
Annuitization.
Good job.
Oh God.
You got it right. We said right here, right? These are the 4 names.
Yeah, annuitization.
Okay, perfect. All right. So let's go to question number 2. Eddie, again, this is for you because I already went over this with Josita. So question number 2.
In an annuity contract, the owner always has which of the following rights? A, to receive annuity payment. B, to designate or change an annuitant. C, to act as a measuring life for benefits. And D, to receive a guaranteed minimum payout.
So what's the correct answer? Remember the key word is always.
Yeah, okay. The owner always has which of the following rights? To receive annuity payment, to designate. Okay, B, to designate or change the annuitant.
Okay, and you're correct. The key word is always. Now,
always, yeah.
You see how they trick you here to receive annuity payments? And of course, you'll be like, you are the owner now, so you're going to receive payments. No. Annuity is meant for the annuitant to receive benefits, but this says the owner, right? Now, if they had said the annuitant, then A was going to be the correct answer, but it says the owner. The owner does not receive annuity payments unless the owner is the same as the annuitant. But if the owner is different from the annuitant, then that payment goes to the annuitant. Very important. But the owner can designate or change the annuitant, right?
Okay. Yeah.
Now, to act as the measuring life for the for benefits, no, it's the annuitant. That's who they act, they use their life to determine, as I told you guys, the age, right? So if the annuitant is older, their payment will be bigger. If they're younger, the payment will be lower, right? Then to receive guaranteed minimum payout. No, that's not the owner. Anything that receives with benefit, the owner doesn't get any benefit. All the benefit goes to the annuitant, and if the annuitant is there, goes to the beneficiary. All right, let's go here to question number 3.
Who is the annuitant in an annuity contract? The individual who pays premiums. B, the individual whose life expectancy determines payment amount. C, the legal owner of the contract, and D, the insurer providing the annuity benefits.
Okay, so what's the correct answer?
Insurer providing the annuity benefits.
For you, what's the answer, Josita?
I would say maybe I'll go for D.
D. Okay, Josita, what's your answer?
Yes, sir.
D. Okay, so the annuitant is the who is the annuitant?
The benefits?
Hold on, you said D or B?
Me?
Yeah, what do you say?
I said D.
D as in dog. What
Yeah,
about?
dog. You said what?
Josita, what about you?
So let me read the question. Who is the annuitant in an annuity contract? The individual who pays the premium, the individual whose life expires determine the payment amount, the legal owner of the contract. It's D, sir.
D as in dog.
Yeah.
Hey guys, you guys will kill me.
It's wrong.
The insurer providing the
Oh,
annuitant.
the answer is B. I said the
Individual
annuitant is the
expectancy. Oh, yeah.
life expectancy determines payment amounts. That's why I just gave you guys the example, right? So if the annuitant is old, their premium
Oh, yeah.
payments will be higher because they're expected to die sooner, right? If they're younger, so the person whose life expectancy determines how much the insurance company will pay is the annuitant. Because remember, the whole purpose of an annuity is to pay benefits to the annuitant. So it's the annuitant's age, their life expectancy, their gender, all those things that will determine how much. Again, let's come back here to the notes, and that's why I do the practice questions when we finish a topic. Go through the questions to make sure you guys understand it, right? So yeah. Again, I will share this notes with you.
Okay.
I'll put it in the group chat. But yeah, you see right here, the annuitant. I have it right there in the notes, right?
It's life.
You sure you started this note? Because I have it right here. I'm sorry, I'm putting you on the spot. But the person whose life the annuity is written on, they have to die before benefits are paid out. They're entitled to receive benefits, must be a natural person. So it's the person whose life expectancy everything is based on. It's the person they take into account their life expectancy. It's the person who is entitled to receive benefits, everything. So how much they will pay would be determined on that person's life expectancy. If the insurance company thinks that person will die soon, the benefit payments will be higher. If they think they're going to die, they're going to die late, right? Or they got more time to live, the benefit payments will be lower, right? So everything, when you think about benefits, who the policy is written on, the life expectancy, who is the insured, it's all the annuitant. So let's read the explanation. Well, if I show you the answer, then you're going to see the answer for the other one. Hold on. Let me see if I can block the answer for the other question. Because I don't want you guys to see what the next question will be. All right, let me see if I can block that out. All right, perfect. Okay, so I blacked that out. So let's come here and read this. Eddie, you can go ahead and read.
The annuitant is the person whose life expectancy determines the amount and duration of annuity benefits. This role is similar to the insured in life insurance. The owner may or may not be the annuitant, but the insurer is never the annuitant.
Yes, because think about it, right? How will I be selling something to you? Because again, you guys have to know this, right? So the insurer, another name for insurer is insurance company, right? Insurance company. So on your exam, most of the time they're not going to use insurance company. They're going to. So you got to know. So how would the insurance company be selling you
annuity
and
benefit?
And they receiving the benefits, right? It doesn't make sense. But the reason you pick that answer is because you probably didn't know who the insurer is.
Yeah, and I think because of the annuity benefits at the end.
Remember, it's the insurer that sells the annuity to you, right? All right, so let's just go through some quick acronyms here because this is going to help you. So insurer, again, these are names, right? Insurer can be called insurance company, right? Another name is insurance company. Because on your exam, they use these interchangeably. Producer, or let's say agent. Another name is field agent. Another name is producer. Okay, so you have to know all these things. Life and death benefits. Another name is limit of liability. Another name is policy proceeds. Another name is face amount. So you got to know all these synonyms, right? Because the reason I'm assuming you guys got that wrong is because you didn't know who the insurer is. The insurer is the insurance company. But on the exam, most of the time, they're going to use the word insurer. They're not going to use insurance company. So just know that those are the same. Okay? All right. Let's do one more question because I know it's 10:25. I'm sorry I went over time. I know some of you have stuff to do. You can write that down. So these are all, so you got to know all those, you have to know all those names, guys. Another one to add here, surrender is the same as cancel or terminate. Lapse means the insurance cancel. So these are all terms. You got to know. Again, they're not going to ask you who is the insurer in a life insurance contract. No, they're not going to, but they're going to ask like this question that if you don't know who the insurer is, then you're going to get it wrong. So highlighting, yeah, all of those. If you want, you can just take a picture of it or a screenshot. All right, are you guys finished? So let's do one more question. Question number 4, Eddie, you can go ahead.
The beneficiary in an annuity contract is entitled to what? A, policy loans during the accumulation period. B, death benefits if the owner or annuitant dies before annuity. C, guaranteed lifetime payments. And D, tax-free distributions regardless of age.
So what's the correct answer?
Annuity.
And Josita, be reading this too, so you can tell me your answer.
Death benefit.
Josita, what's your answer?
Yes, sir.
D as in dog?
B as a boy.
As in boy? Okay, let's wait for Eddie.
Yeah, I will take that to death benefits if the owner of the annuitant dies before annuity.
Yep, and you are correct, right? So as we said, the beneficiary in an annuity contract, the only thing they're entitled to is the death benefit, but only if the annuitant dies before annuitization, right? Yeah, they say owner or annuitant. Again, if the owner is the same as the annuitant, right? But they're only entitled to death benefits before annuitization. We say annuitization is where now you switch from benefit payments to receiving payouts. Now, during the annuity phase, there's no guarantee that they'll receive any death benefit because if the annuitant selects, let's say, life-only payment, then that means they say, only pay me money when I die. My beneficiary receives money. Pay me the most money as possible for the rest of my life. So it depends on the payout option that the annuitant selects, right? But what the beneficiary is entitled to is benefits, right? The premiums, the total premiums paid plus interest during the accumulation period if the annuitant dies during the accumulation period. So let's take here Eddie, for example. Eddie has an annuity, and let's say it has a 10-year accumulation period. So Eddie starts this annuity in January of 2025, and he's supposed to go to January of 2035, right? And he's supposed to be paying every month. But let's say, God forbid, Eddie dies 5 years later. So he's still doing the accumulation phase. He's still, the pay-in phase, right? So Eddie's beneficiary will be entitled to all the premiums he paid for those 5 years plus interest. But let's say Eddie dies after those 10 years and Eddie selected a life-only payment option to say, pay me money for the rest of my life and don't pay my beneficiary anything else around that. So if Eddie dies during a annuity phase and he selected life-only payment option, then how much will his beneficiary receive, Josita?
I think nothing.
Perfect, nothing. All right. So I know we went over time. We went 30 minutes over time. I'll pause here. Does anyone else have any quick questions?
All right. So thank you very much for watching. If you're watching this on YouTube or if you're listening on the podcast, thank you very much. We are doing something amazing here. Our pass rate is 98%. So 98% of our students pass their life insurance exam with flying colors. The national pass rate is 50%. Last year, 200,000 people failed their life insurance exam. And some of those people who failed, some of them studied for up to 2 months. Some of them have a master's degree. So they didn't fail because they didn't study hard enough. They didn't fail because they were dumb. No, they failed because they didn't know the system, right? They didn't follow the system. And to pass this life insurance exam, there's a system. The good news is we've cracked that code to pass your life insurance exam. As I said, our pass rate is 98%. We've helped students pass their life insurance, people who have even failed their exam up to 7 or 8 times. They've come to us, we've helped them pass. We've helped people as young as 18 years old pass their life insurance exam, people as old as 67 years old pass the life insurance exam, people from almost every single state, from Washington to New Jersey, New York, California, you name it, all across the United States of America. We have helped people pass their life insurance exam, and you will be our next success story. So if you don't want to fail your exam, like 200,000 people last year failed their life insurance exam, then book a one-on-one consultation. That consultation is free, or you could just click the link in the description and sign up for one of our membership programs or sign up for our self-study. Until next time, we wish you all the best on your life insurance exam, and we wish you a successful insurance career.